Pretty much everyone on Earth right now is talking about whether or not the housing market is going to crash. And I don't personally believe the market is going to crash. I think the more likely scenario is that prices are going to flatten, or they might even go slightly negative at some point in the next couple of years. And that to me is not a crash. That is a correction. When the housing market goes down by just a couple of points, anything less than 10%, I call that a correction, not a crash. But of course, a crash scenario is plausible, and it is probably more likely now than at any other time during the last decade or 12 years or so. Many high-profile people, investors, real estate investors, all sorts of investors, economists have been saying the market is going to crash. Some of those people, let's be honest and look at how long they've been saying this, because some of them have been saying it since 2014 or 2015. And if it crashes now, you can't let them say that they've been right, because they've been wrong and missed out on the greatest bull run in housing prices in history. So take all of that with a grain of salt. But a lot of people are talking about this. It's the top of mind for a lot of people, real estate investors and ordinary Americans alike. So I think it's important that we dig into the data and see what would actually have to happen logistically for the housing market to truly crash. And that means prices to drop 10% or more. Let's dig into the data and figure out, is this actually likely to happen? What's going on? This is Dave Meyer, Vice President of Data and Analytics at BiggerPockets and host of the newest BiggerPockets podcast called On the Market. And if you like learning about the housing market and data behind real estate investing, which I'm assuming you do because you're watching this video right now, if you like that kind of information, make sure to check out the brand new On the Market podcast and YouTube channel. The link is in the show notes, so definitely check that out. It is a new BiggerPockets YouTube channel with all sorts of videos from myself and many of the other On the Market panelists, sharing information about how to get ahead, how to have an advantage, and how to successfully invest in any type of housing market. If you go over there, please make sure to subscribe, hit us up in the comments. We'd love to hear what you think about the new channel. With that, let's jump into today's topic, which is what actually would have to happen for the housing market to crash. When we look at this, when we examine this question, there are basically two variables that we need to consider: supply and demand. That is how prices set. For the market to crash, the relationship between these two variables, between supply and demand, it needs to shift, because right now there is much, much more demand than there is supply. And when that happens, when there is more demand than there is supply, that is a recipe for prices to go up. And that's what we've been seeing over the last few years. For a crash to happen, on the other hand, we need to see a rapid shift to an environment where there is more supply than demand, basically the opposite of what's going on right now. This is really the only way. This is the only way that prices go down. Supply exceeds demand. Will that happen? Let's look at the data, at what's going on with both supply and demand, and then you can decide for yourself what's likely to happen. First, let's look at demand, because demand has been super high for a while now, and that has been fueled by a few things. First and foremost, it is fueled by home buyers, primarily led by millennials who are in their peak family formation years. They are the biggest generation now, and they want homes. They are at the peak home buying age. And I know a lot of people, I'm sure people are going to tell me this in the comments, I know a lot of people think this is all driven by investors or Zillow that is leading demand. That's just not true. Only about 19% of homes are purchased by investors. Millennials who just want a place to live are primary drivers fueling demand. Now, yes, there are secondary and tertiary drivers, and investor activity is one of those, and second home activity is also another one of those, and that is contributing to demand. But that is not the majority of what's going on. But all told, when we look at demand, there are many forces that have pushed up demand over the last couple of years. So the question is that going to continue? In my opinion, No, I think demand is going to start declining, at least in certain areas of the economy or certain markets. And the primary reason is interest rates. Interest rates rose super fast in the first 4 months of the year, right? About the beginning of the year, the average rate on a 30-year fixed rate mortgage was just over 3%. Now it is over 5%, which is very, very considerable. And I do think that the rate of growth in interest rate is going to slow down. And I know the Fed is going to keep raising interest rates, but the Fed's interest rate is not directly tied to mortgage rates. Yes, they are indirectly tied, but the market, it doesn't actually wait for the Fed to actually raise rates. They're not just waiting like, oh, they're going to raise rates next month. We'll wait then, and then we'll adjust all of our expectations for the economy. That's not what happens. Investors, people who invest in bonds, and banks who are issuing mortgages look at things like the Fed's dot plot to estimate where rates are going to be a few years down the line and incorporate that into their expectations. And so the Fed shifted 6 months ago in their thinking, and the market has been pricing that shift in Fed thinking for a couple months. And mortgage prices are probably going to keep going up, but they're not going to keep going up at the same rate in my mind. Monthly mortgage costs so far over the last year, from March of 2021 to March of 2022, went up over 40%. That is absolutely insane. NAR, the National Association of Realtors, estimates that this increase in mortgage prices, which is both made up of interest rates and rising home prices, is going to price out 15 million American households. That, my friends, is going to lower demand. That is why I'm saying I don't think demand can keep going up, because it's just getting more expensive and more people cannot afford to get into the housing market to the tune of about 15 million households in 2022 alone. So, in my opinion, that is going to lower demand. This is really significant. But to crash the market, which is what we're talking about here today, we need to see a very dramatic drop in demand and a very quick drop in demand. Let's look at the data. I mean, one data point I like to look at to see if this is going to happen is the Mortgage Bankers Association survey. They put out this survey every week to a bunch of mortgage banks and see, are they getting more interest? Are they getting less interest? And right now, purchase applications, so not refis, people who are applying for mortgages to buy a new house, are down 17% year over year. And that's a lot. I mean, that is very significant. Although 17% sounds like a lot, and don't get me wrong, it is. It hasn't been enough, at least so far, to slow down the market. We are still seeing prices stay at a super high rate. And a lot of that is because last year, in 2021, demand was so insanely high that when you think about coming down 17% from 2021, we're still at a pretty normal year for demand. A lot of people still want to get in houses. At this point in the year, demand, it is starting to wane with higher rates, but not enough to make any sort of dent in prices for inventory, at least with the data I have available as of this recording, which is early May 2022. I mean, if we were going to see demand just drop off of a cliff because of interest rates, we probably would have saw it in February or March, because that's when rates were rising faster than any time I have ever seen them in my career. That's what's happening with demand. But demand obviously doesn't operate in a vacuum. You can't just look at the demand side of the equation. You need to look at inventory or supply, which is the big story in 2022. And to me, if you take anything away from this video, listen to this. Until inventory recovers to a normal level, until there is more houses regularly sitting on the market, there is no chance of a housing market crash. Think about it logistically. No seller, if you're going to sell your home, no seller is going to proactively lower prices. They need to be forced to lower the price of their home. It's not like they're seeing these rates rise like we all are and thinking like, I think all these rates are going up, so I'm just gonna, proactively not list my home for as much as I think I can get it. I think I'm gonna lower prices because rates are going up. Oh, wow. Dave said that the MBA survey shows 17% fewer purchase applications. I'm going to just lower my listing by $50,000 and I'll be happy with that. That's never going to happen. We need to see houses sit on the market for long periods of time. Then and only then, once sellers see their properties sit for a few weeks or even a few months, will they consider lowering prices. And if that happens for a couple of months, then sellers might adjust their expectations for sales price, but that's going to take some time. Yeah, of course, if demand dried up instantly, as we discussed before, that could change it, but again, that is unlikely. We just saw rates rise faster than at any time I've ever seen, and demand didn't evaporate. People are still buying. Yes, demand is down, but it didn't dry up immediately, which is what it would take for the market to crash. So let's look a little further into where we are with inventory. Just look at this chart here from Redfin. There is just so little inventory. It's absurd. We used to have about 2 million houses on the market in the recovery from the Great Recession. That's from like 2013 to 2016. And then pre-pandemic, like 2016 to 2019, we expected about 1.6 to 1.7 million properties to be on the market during the peak summer selling months. What do we have now? About 600,000. So down from about 1.6, 1.7 million to 600,000. Think about that. In 2017 and 2019, prices were largely going up. There was a blip there where it went flat or a little negative in 2018, but they were largely going up. They were still going up when we had 1.5 million homes on the market. Now we have 600,000. Days on market is the same story. Pre-pandemic, it was about 45 days. Now, even with higher rates, it's still under 20. And I know people like to just say that the market is going to crash because prices have gone up so much. But think about this. Supply and demand determines price. That is the basis of our free market economy. Always. That is always how it works. And supply is extremely low. So even if it starts to recover, that's not going to cause a crash. It is just going to cause a moderation in housing prices. We need to get to more normal levels of days on market and inventory before prices will come down, and we have a long way to go. So the question, at least to me, is what would make the market crash? That's what we're talking about today. And with inventory, it's the same thing as demand. We would need to see a rapid rise in inventory to cause a crash. I think it actually needs to be almost double. We're at 600,000 right now. We need at least 1.2, which is still less than where we were pre-pandemic. We probably need for it to triple to get to about 1.8 over the next couple of months before a crash is really even feasible in my mind. So could this happen? Let's take a look. One place we could get that is from new listings. And if you look at those charts, they're actually down over the last few months. We're not seeing new listings going up, even with these increase in rates. And you have to ask yourself why. And to me, it's the lock-in effect. People don't want to sell into this market. An estimated 60% of homeowners right now have a mortgage rate below 4%. Why would they want to sell into a super expensive market only to get a higher rate on their mortgage and face stiff competition for their next home? It's just not an attractive time to sell your home. So to me, it is unlikely we're going to see this glut of inventory hit the market due to new listings. Of course, the other source could be foreclosures. And a lot of people have been saying for like 2 years now that there's going to be a foreclosure crisis like we saw in the Great Recession, but that's not going to happen. I know people keep saying it will, but it's just not going to happen. I've been saying this for over a year now. And listen, I don't know everything. I am wrong about a lot of stuff. I don't know if prices are going to keep going up or if the market's going to crash. I'm telling you what I think based on probability and what the data says, but we can't know for sure. But one thing I feel extremely confident about is there will not be a foreclosure crisis due to COVID and the forbearance program. It is not going to happen. The short story is the forbearance program worked. There are almost no foreclosures happening right now, and there aren't any on the horizon. And people said, oh yeah, once the moratoriums are lifted, there's going to be foreclosures. Not happening. And even if all of the sudden millions of people did go into default, which again is not happening, it would take months or even years for that inventory to hit the market. This just isn't 2008. People have equity in their homes. The people who have debt are well positioned to service their debt. 90% of people who exited forbearance did so in good standing. It just worked. We're not going to see a glut of foreclosures. So this, combined with new listings, I just don't see how a rapid increase in inventory would happen, which is again what it would take for the market to actually crash. Now that we've looked at supply, we've looked at demand, we've looked at some of the data, what I'm thinking is that there is a good chance that prices will flatten in the coming years. I think that's going to happen. I think there's even a good chance that prices dip a little bit as supply and demand start to rebalance. And that is healthy in my opinion. That needs to happen. We need the housing market to calm down. But as we just discussed, I don't see anything in the data right now that suggests we're going to see a rapid decline in demand and or a rapid increase in supply. And we would need one of those two things to happen for an actual crash, which is again a decline in home values of 10% or more to happen. As of now, the fundamentals just do not show that as a likely outcome. Again, could it happen? Yes. I'm just trying to tell you what I think is the most likely situation. If it happens, you would need to see demand fall off very fast and inventory to rise rapidly, and that is just not super likely. To me, the market's going to cool over the coming months and approach more normal levels of growth by end of year. In 2023, I think it's possible we have a flat or even slightly negative year, but that's just my guess. Overall, I'm thinking that we have like a plus minus of 10% over the next 2 to 3 years. So it could go up, but not that much more. And it could go down, but not that much down. And I think we're going to stay in a relatively flat plus or minus 10% over the next couple of years. Because the data right now, that's what it suggests. It just does not suggest that there's going to be huge movement one way or the other. Of course, this is just what the data suggests right now. And I'm going to keep an eye on all of this over the coming months and years. And I will update you very regularly on this channel, or as I said at the top of the show, I'm going to be updating people more regularly on the market channel. So go to the show notes, check out the On the Market YouTube channel, subscribe and hit me up there. Or you can always hit me up on Instagram where I am at the Data Deli if you have any questions or thoughts about this video or really anything else that's going on in the housing market. Thank you all so much for watching. I'll see you all again soon.